Hi, I'm Lee Stone and this is your UFXBank Week in Review. Today, we will be covering some of the major financial events of the past week and how they impact the global currency markets. But before we begin, let's cover the last week's risers and fallers. The Euro-US dollar pair enjoyed a 1.86% jump beginning the week at 130.38 and closing at 132.81. The British pound had a 1.6% increase over the week against the dollar, opening the week at 156.84 and closing at 159.44. The US dollar Japanese yen fell just over 1% on the week, beginning at 86.42 and closing at 85.51. The US Canadian dollar pair fell for the third week in a row, opening the week at 102.93 and closing at 102.75 on Friday. Gold rebounded this week with a 184% increase to $1,203.40, and oil had a good week as well, jumping 2.22% to finish the week at $80.70. In currency news this week, the US dollar made headlines across the board. The Canadian dollar strengthened to a 13-week high against the greenback before relinquishing some of its gains on Friday trading. The British pound is approaching 1.6 levels against the USD, and against the Japanese yen, the dollar has fallen to an 8-month low. Not surprisingly, the dollar dropped against the euro and other major currencies through the week and felt its most significant drops on Friday when the US jobs data came out far worse than expected. For more on this, let's go now to our analyst, Martin Smith.
Hello, Martin.
Hi, Lee.
So let's begin with the Canadian dollar. What happened this week?
Well, Lee, there was really no surprises there. Oil enjoyed solid gains at the beginning of the week, and since the CAD is heavily connected to the price of oil, it saw similar increases. Towards the end of the week, amid the uncertainty surrounding the upcoming release of the US jobs report, momentum did slow on the loonie. However, once the job report was released, the poorer than expected data caused a selling off of oil, and subsequently, of course, a drop in the Canadian dollar followed, nearly 1% to be exact. Obviously, with less production expected out of the largest oil-consuming nation, there's bound to be a drop in the price.
Well, what about the pound? I mean, it also experienced some very strong gains this week.
This is the fourth straight week, in fact, the pound has gained against the dollar. This week, I think, is more a case of good news versus bad news. The good news coming from, of course, the UK, and the bad news out of the US. UK banks received positive outlooks at the beginning of the week, which buoyed the pound's value to nearly 1.6 levels versus the US dollar. Northern Rock Asset Management reported first half profits, as Royal Bank of Scotland and Lloyds Banking Group claimed a decrease in bad loan provisions. So the news indicated that the banks are starting to stabilise, which in turn seems to suggest that the UK recovery is in fact well underway. Adding to the pound's increase, of course, was also Friday's job report out of the US, where an expected 65,000 job losses for July was met by 131,000 in reality. This, of course, has created some concerns that another stimulus package may be in the works.
Continuing with the dollar, so what about the yen?
Well, as you mentioned earlier, the dollar fell to an 8-month low against the yen. The dollar touched this point last week, but was able to pull back some of those losses. Unfortunately for the US dollar, when the data came out on Friday, the slight rebound extended into losses and will likely put greater pressure on Japanese exporters. The Prime Minister of Japan had stated on Thursday that he was cautiously monitoring the economic situation to see if a government response is needed. Japan, of course, being an export-driven economy, and the yen's rise against the dollar is therefore having severe consequences on consumer spending. Ultimately, economists are keeping a close eye on this pair as the yen is fast approaching a 15-year high on the dollar.
Well, let's move on to our Ask the Broker segment.
Okay.
Let's see. Jerry Goodman of Brighton, England writes, what exactly is a pegged currency, and how might it help us in trading decisions?
Yeah, well, a pegged currency, also known as a fixed rate currency, is simply a currency that's linked to another currency's value at a fixed exchange rate. So, for example, the Eastern Caribbean dollar is pegged to the US dollar at a 2.7 to 1 ratio, which means it will not shift much from the exchange rate. A currency that is pegged to the dollar will fluctuate along similar lines to the dollar, of course, because it's pegged to the dollar. And as the dollar appreciates, so the currency will also appreciate. Often we find that this is done in emerging markets or smaller countries whose economies are based on exports. This provides importers and exporters with a stability, of course, in their trading. We find most economies that employ this practice of fixed exchange rates have their currencies pegged to the US dollar, especially the case in countries where the main export is oil, of course, because the dollar is priced, oil is priced in US dollars. As far as I know, this might help us, as far as trading is concerned. There is some value in trading pegged currencies because of the lower risk involved, but of course the returns are that much smaller. Others use it as an indicator of how those pegged currencies will likely move against a common pairing. So for example, if the dollar is falling against the euro, well, you might also assume that trading the euro against the US Caribbean dollar will provide similar returns. However, to be honest, this is not really a very common practice.
Well, thank you for joining us today, Martin.
We hope you enjoyed our weekly review, and we hope you will join us next week. Until next time, be sure to visit us at UFXBank.com for simple, safe, and secure trading. Also, you can follow us on Twitter and Facebook. To submit your questions to our weekly broadcast, please email your questions to Martin Smith at askthebroker@UFXBank.com. For UFX Bank, I'm Lee Stone. Good luck and happy trading.